This episode of the Blackboard is brought to you by Selling SaaS Globally, a SaaS leader's practical guide to global expansion. Sign up by clicking the annotation above. What is marginal revenue? Marginal revenue is the increase in revenue that results from the sale of one additional product. Taking your marginal revenue and stacking it up against your marginal cost will help you gauge your business's performance and help you make better decisions. Marginal cost is the amount it costs you to produce additional products. It's important to note that since marginal revenue is subject to the law of diminishing returns, it will eventually slow down with an increase in output level. As your output continues to grow, you should make sure to monitor your marginal revenue and try and increase it until it matches or exceeds that of your marginal cost. If you're not doing that, you're not making money. Let's look at how to calculate it. Marginal revenue equals change in revenue divided by change in quantity. Say a company increases its production of product X by 100 units and receives $200 in revenue. Marginal revenue will be $2. Now, stacking that number up against your marginal cost will help determine how your business is performing. If your marginal cost is $2, you're breaking even. But why is knowing your marginal revenue so important? Here are 3 reasons why you need to calculate it. Number 1, you'll understand the revenue impact of each extra unit sold. Selling more of a product or service generally means you make more money. But each extra sale also can come with higher costs. Marginal revenue helps you figure out how much extra money you'll make from each additional sale. However, there's a point where making more sales can stop being profitable because of the extra costs that are outweighing the extra revenue. And that's where you should consider stopping and figuring out how to wrangle some of those costs. Number 2, you'll understand the relationship between sales and market demand. Marginal revenue helps companies understand the relationship between sales, market demand, and market competition. In a perfectly competitive market, marginal revenue equals the product price at all output levels. But in reality, due to competition, the market is always going to be in flux. Number 3, you know when you're reaching profit maximization. Since businesses want to maximize profit, they need to keep producing more output so long as each additional unit adds more to the revenue side than the cost side. Past the profit maximization point, a company cannot make any more money, and it's in its best interest to stop production. Click here for the next video in our series and make sure you subscribe to get episodes of the Blackboard delivered straight to your inbox.